Joining me now is Daan Struyven, the head of oil research at Goldman Sachs. Dan, thanks for coming on the show. Stronger than expected data has shown evidence of a more resilient economy, definitely in the US, and surprisingly in the EU too as well. This has given credence to the soft landing scenario in the second half of this year. Tell us, how have those data points found their way onto your oil demand outlook for 2023, and where exactly are we seeing this demand come from for an all-time high in the third quarter?
The confidence in our Goldman Research House view that the US and the global economy are on track for a soft landing has increased further over the last few months, both because of resilient activity data, especially in the US, but also many emerging markets, and the fact that inflation is now coming down, suggesting to us that the Fed is now done hiking. How's that showing up in our oil demand forecasts? Our oil demand forecasts show pretty firm growth. We now think that oil demand reached an all-time high in July, and the firm global activity data are showing up in the demand forecast, both because of strong high-frequency demand data. For instance, in May, US oil demand reached the highest level ever for the month of May, and through our models for demand, where GDP is the main driver of oil demand growth. And we think that growth will continue to be strong this year, with growth really coming from emerging markets, including places like India, also the Middle East, a seasonal boost from travel demand in the OECD. And then if you break it down by sector, it's really coming from the services sector, which continues to expand.
Dan, but how are we talking about all-time highs in global oil demand, whereas China's recovery is still not firing on all cylinders? Far from it. By some estimates, China's oil demand growth in the first half was about 1.1 million barrels per day, keeping in mind a weak first half in 2022 due to COVID restrictions, mind you. So China accounts for about 70% of the IEA's global demand growth this year, of around 2.2 million barrels a day in total. So what are your expectations for Chinese oil demand in the second half particularly?
So I would argue that oil demand has been pretty solid, and more solid than the overall Chinese economy, which is being dragged down by weakness in the property sector and weakness in the manufacturing exports sector. However, we estimate that 70% of oil demand is really driven by the services sector, and Chinese citizens are driving, they're flying domestically, and oil demand, we think, is up by around 1.25 million barrels per day since the fourth quarter of last year. From here, we see an additional 300 kbd of sequential growth from current levels. You're currently around 60 million barrels per day. We think we will end 2024 around 16.3, 16.4 million barrels per day. So solid growth out of China, but most of the growth we think is behind us, as mobility, especially driving, is pretty much back to normal levels in China.
Let's move on and discuss the supply side of the equation. Russia has announced a cut in oil exports in August of 500,000 barrels a day and a tapered 300,000 barrels per day in September. There are indications that Russia's oil exports have begun dropping in recent weeks. Where do you see Russia's export at currently, and to what extent do you see Russia delivering fully as promised on these cuts?
So in the first half of this year, compliance of Russia with its pledge to cut production by 500 kbd was only very partial. However, what we've seen over the last 2 to 3 months is that Russia has started to fully implement the first 500 kbd cut, and has actually started to partially implement the second series of cuts. On our estimates, Russia production is now about 600 kbd lower than the February 2023 reference level. In our baseline forecast, Russian production sort of stays flat at around 10.7 million barrels per day for total liquids production. However, I think for the first time in a while, I think that the risks to Russian supply forecasts are tilted to the downside. And if Russia were to fully implement the second series of cuts, then our Brent forecast would be close to $100 per barrel 12 months ahead, as opposed to our baseline of 93. So for the first time in a while, I think Russia's supply is actually a bullish risk.
So you have forecast an oil deficit of about 2 million barrels per day in the third quarter. Saudi has just extended its extra cuts through to the end of September. Do you expect any further extensions this year, or is the Saudi job done? And how have your expected deficits changed for the coming months in light of the last Saudi extension?
So the latest extension through September was in line with our forecast. So we haven't changed our view that you're going to run pretty large deficits in the third quarter, just above 2 million barrels per day. Our forecast is that the 1 million barrels per day so-called lollipop cut will be turned to 500,000 barrels per day from October onwards, where Saudi crude production rises from 9 million barrels per day in the third quarter to 9.5 million barrels per day in the fourth quarter. However, I think that the risks are skewed towards lower Saudi production for longer if Saudi Arabia desires to lean in into the rally for longer and wants to see more sustained evidence of higher prices and a recovery in positioning. Our base case is that Saudi Arabia tapers the cut because Saudi Arabia has some significant spare capacity, and because we think that the current price level, $86 per barrel, is roughly in the middle of what we think is the sweet OPEC spot range for prices for Brent of $80 to $100 per barrel. And so since we're now approaching the middle of this sweet spot, our base case is that Saudi Arabia will gradually bring back its barrels to the market.
India has been indulging itself in Russian oil for months now. Russia has overtaken many other exporters in India as its market share increases at the expense of other exporters. Is this sustainable, and should other exporters such as Saudi and Iraq be worried?
So what has happened this year is that you have seen a very large drop-off in exports out of Russia to Europe. And these barrels have been rerouted primarily to India, second to China, and to a lesser extent places such as Turkey or Latin America. This is a result of the price caps and the EU sanctions on Russian barrels. I understand where the worry is coming from a Middle Eastern perspective, because the Asian market, especially the Indian market, we think is a high growth market. We think that in a normal year, Indian oil demand is growing by about 200, perhaps even 300,000 barrels per day. So in a sense, India is sort of the new China from an oil demand and a GDP growth perspective. That said, I wouldn't be overly concerned from the perspective of producers in the Middle East, both because number one, if Europe stops buying barrels from Russia, opportunities open up in Europe. Second, from a long-run perspective, I think Middle Eastern producers are well positioned with low break-even production costs, very significant investments in carbon capture and storage and decarbonization technologies more broadly, and a very strategic location. And finally, countries such as Saudi Arabia are also investing in refineries in Asia, including China, and so are getting closer to the customer.
U.S. oil production is expected to grow by a measly 200,000 barrels per day this year, as per your expectations. Oil rigs have dropped considerably this year in the shale oil patch, but some observers say that shale activity in the Permian remains at peak levels despite the drop in rig count, as drillers focus on more productive wells and as costs continue to drop. With some experts expecting U.S. production to hit a record this year at around 13 million barrels per day. What's your view on this?
So I think your characterization is correct. While the rig count is down by just over 15% since late last year, production, U.S. crude production, has sort of been moving sideways for several months in a row, because we're basically producing more oil per well and per rig. And if you look beneath the surface, what's really happening is that the rig count is concentrated among private, smaller producers who produce less barrels for a given rig, whereas the larger, typically public companies, have kept their rig count flat and typically guide towards some modest additional growth over the next year. Big picture, we only have modest growth for US supply in our forecast, despite the fact that we forecast prices above the forwards with Brent at 93, 12 months ahead. And there's really two key structural reasons. Number one, we are convinced that US producers are committed to capital discipline and want to make sure that they return enough cash to shareholders and don't build up excess capacity as they have done in prior boom-bust cycles. And second, at the margin, the geology of US production is becoming somewhat less favorable every year, including in the Permian, which has really been the main engine of global supply growth over the past decade.
So, Dan, is Brent, after an exceptional performance in the last 7 weeks, somewhat overextended currently at $86 a barrel? I mean, you've mentioned that it could go to $90 a barrel, even to 100, but take us through your price expectations for the next couple of quarters.
Yeah, base case, you're flat for the rest of the year. Our December 2023 price forecast for Brent is 86. We're now at 86. We had been looking for the rally we have seen over the last 6-7 weeks for a long time, because it was our view that you would see large summer deficits, which would create upward pressure on time spreads and therefore crude prices. At this point, our fundamental analysis suggests that oil prices are now basically in line with their fair value for the near term. That said, we think that the forwards for 2024 are too low. So we think that in a year you will be in the low 90s. We have Brent at 93, whereas the forwards are in the low 80s. We continue to see some upward pressure in prices in early 2024 because we have some deficits not only in the second half of this year but also in 2024.
Dan, finally, with global decarbonization efforts casting a shadow over long-term outlooks for both oil supply and demand, what does this mean for investments in oil projects, and how will that affect oil prices in the very long term?
It's correct that the direct effect of decarbonization on oil demand and therefore oil prices is negative. That said, I don't think it's obvious that decarbonization will necessarily lead to lower oil prices. Really, two key reasons. Number one, in the absence of investment, global oil supply will drop every year by 5 to 6% because of the so-called geological decline rates. Second, I believe that because the uncertainty about long-run oil demand is so elevated that over time, investors will require a higher risk premium to compensate for the risk associated with the uncertainty about oil demand and the possibility to have so-called stranded assets. If investors require a higher risk premium, that means that all other things equal, to convince investors to put their money in oil projects, long-dated oil prices, the back end of the curve, will have to rise higher to compensate investors. So in short, it's not clear that decarbonization means lower oil prices.
Daan Struyven, Head of Oil Research at Goldman Sachs, thank you very much for taking the time and coming on the show.
Thanks a lot for having me.